Hello and welcome to Skills to Pay the Bills in today's segment of JustAskFreeman.com. We are your host and co-host, Freeman and Carolyn Owen. Carolyn, we're going to talk, what are we going to talk about today?
Well, Freeman, we are going to talk about a great book that is hot off the press entitled Top 10 IRA Mistakes, How to Avoid IRA Tax Traps. It's by author, financial advisor, teacher, and mentor David F. Royer, who has been in the financial services industry since 1969, or rather 50 years.
That's a long time.
And Freeman, you had the distinct honor of giving your comments on the book. So what do you think about it?
Well, Carolyn, let me tell you, this book is awesome. And it was indeed an honor for me to provide comments. Now, we have so much to cover today, all righty? In addition to that, it may take approximately 2 segments for us to share the important elements of this educational work. So let's get started.
Well, let's start with dispelling some of the IRA myths. You know, myth number 1 is that you own your IRA, but do you really?
Well, that's true in some circumstances, and most circumstances. And the other circumstance is that if you inherit an IRA, you don't necessarily own it. There are advantages with the husband and wife where if one predeceases the other, they can take ownership of the other spouse's IRA. Another myth number 2 is that you can beat the tax. You know, Carolyn, we've had a number of folks that come to us and they say, well, look, if I take a distribution from my employer-sponsored retirement account, I'm refer to that as a qualified accounts from henceforth, like 401ks or TSPs or 403bs, the IRA. They say, well, I don't want to pay any taxes on the distribution. Well, that's wrong. Whether you like it or not, you cannot beat the tax. And then the other response is, well, is there anything that I can do? Well, these funds you put away or contribute to those qualified plans, they are pre-taxed. So, well, IRS looks forward to, and which we will discuss later on in this segment, to taxing those distributions. So that there's nothing you can do about it is myth number 3.
Okay. Well, I'm going to give a brief history of retirement plans in America. Mm-hmm. You know, on August 14th in 1935, President Roosevelt signed into law the Social Security Act. Now, this law was to help Americans supplement their personal retirement savings,
exactly,
not to replace it.
That's right. Key word there, supplement. Do you know that today, 61% of those who are receiving Social Security, those Social Security benefits is the only means of their retirement income. There is no other income stream. I want to add this too. Americans did not pay any income tax on their Social Security benefits until 1983, when Congress, of course, they broke that promise. Now, I want to add this too, that the more you earn during retirement to support yourself, the more likely you'll pay income tax on your Social Security benefits. And this is important too, audience. I want to emphasize this to our viewing audience. Distributions from a traditional IRA are taxed as ordinary income. So increases in the taxable income can also increase the tax on your Social Security benefits. Now, what we want to do is look at the birth of modern retirement plans in America.
Well, you know, in 1974, Congress passed the Employee Retirement Income Securities Act,
exactly,
or what is better known as ERISA.
Right.
Now, this landmark legislation drew the 401ks, the 403bs, the SEPs, the IRAs.
The TSPs.
Yes, TSPs. But you know, ERISA was designed to encourage Americans to prepare for retirement and become less dependent on Uncle Sam.
Now, let me just interject 4 incentives, very attractive incentives to save. Participants are allowed to deduct their contributions from their income tax. It's often referred to as salary reduction. And Carolyn, gains, tax deferred. Now, these retirement accounts also are exempt from creditors. And most of the private sector and the public sector offer payroll deduction. So it makes it easier for employees to save for retirement.
Well, you know, save for retirement with all those incentives was irresistible.
Exactly.
But there was a catch.
And here's the catch. You save the tax on the seed, all right? Now, watch where I go with this. But now you must pay the tax on the crop. Now, let me see if I can draw a little analogy, folks. When you save the tax on a seed, you are contributing to your employer-sponsored retirement account, or your IRA, all right? But now when you pay the tax on the crop, when it's time to harvest, your senior partner, IRS, steps in. Now the thing is, your senior partner did not support you with the volatility that exists in the market, the fees, the loads. But then again, when it's time to harvest, when it's time for required minimum distributions, or I should say, when there's a mandatory withdrawal, okay, at age 70.5, that's when your senior partner steps right in and participates in the distribution with taxes. Now, let's look at mistake number one.
Well, mistake number one is missing a required minimum distribution, or RMD.
Right.
Now, you know, the first taxable RMD must be taken on April 1st of the year after the IRA owner turns 70.5.
Exactly.
Now, this is called the required beginning date, or RBD.
Alrighty. Now, folks, I want you to understand that future required distributions are based on the account value as of December 31st of the prior year, and it must be taken by December 31 of the current year. And so, therefore, our senior partner, this is how the IRS dictates when the IRA taxes must be paid. Now, Carolyn and Carolyn, what would happen if you decide to take your first mandatory withdrawal from your qualified plan, okay, April 1? Can you tell me what would happen at, and say, by the end of the year, December 31 of that current year, I should put it that way?
Well, you know, you're certainly right that on April 1st they can delay and take the first.
Right.
But if they do that, then they end up with two taxable events, because they, on December 31st, they have to take the RMD.
Exactly. So that's why it's so important to know when to take your required, what we refer to it as required minimum distributions, in the year you turn 70.5. And as you indicated there, Carolyn, that it's two taxable events. But here's the kicker. There are extreme penalties that are charged if the IRA owner fails to take the full RMD by the deadline. In addition to paying income tax on the amount that they should have taken out, the owner will also owe an excise tax equal to 50% of the missed deadline, or I should say 50% penalty on the amount that's taken out. This could, though, should have been taken out, and this creates a tax burden of more than 80% on missed RMDs. Let me give you a good example.
Okay.
Let's take this, there's a gentleman that we know was not our client until we educated him a little bit there. He was supposed to take, he had $500,000 in income producing assets. That was his IRA. He indicated that he did not want to take the required minimum distribution, which was approximately $26,000. He said, I don't need the money. I'm not taking this RMD. And he was adamant about it. Well, we had to inform him, okay. And again, he was not our client at the time, but we went on and informed him that if you do not take that $26,000, you're taxed on the $26,000, plus there is an excise tax of $13,000. So for a $26,000 distribution, he would wind up paying taxes, and is taxable on $40,000, $26,000 for what he should have taken out, and a $13,000 penalty. That's mistake number one, missing that required minimum distribution. Now, mistake number two,
Mistake number 2 is not taking advantage of the stretch option. You know, the tax code can transform your IRA into a lifetime income for 3 generations.
That's right.
But you have to set up the beneficiary documents properly.
You must set up those beneficiary documents properly. In the mid 2000s, prior to that time, any inheritance for non-spouses, any inheritance that, say, maybe your children, your grandchildren, or aunt, uncle, or whomever, they were given the distribution or that IRA when they received it. They were taxed on the entire amount. It was a lump sum. But after that 2006 bill, it allowed non-spouses, to receive the proceeds over their life expectancy. Therefore, they paid a smaller tax liability and could stretch it over their life expectancy, and the balance, of course, while they're taking a smaller amount out, is growing, tax deferred. When it comes to husband and wives, if one of the spouses had not reached 70 and a half, in the event of premature death of one of the spouses who have not reached 70 and a half, they can place and own that IRA of the other spouse, take ownership, and then put that IRA into their own IRA. Now, when it comes to if in the event there's a premature death of one of the spouses, who have reached 70 and a half, then what happens is when the spouse takes ownership, they must start taking the required minimum distribution. And of course, that's based on their life expectancy. So the tax code that transfer these multi-generational IRAs into a lifetime income, that is fantastic. We've got a few seconds here, but it's time for a short break. And we'll return after these important messages. I'd like for you to stay with us. This is the segment JustAskFreeman.com on skills to pay the bills. And we'll be right back.
He's the face of our future, tutoring and mentoring tomorrow's leaders. She's the face of hope, helping communities recover from devastating disasters. He's the face of independence, making sure that those who need assistance can remain in their own homes. These are the faces of experience, making a difference for generations. This is Senior Corps. Visit nationalservice.gov. This message brought to you by the Corporation for National and Community Service.
Welcome back. You're watching Skills to Pay the Bills in today's segment of JustAskFreeman.com with Freeman and Carolyn Owen. You know, Carolyn, prior to the break, we were talking about the stretch option. I feel that a lot of folks they're unaware of the stretch option and how they can have a legacy for their children, grandchildren, or any non-spouse. So what I would recommend is that since we're taking and we're talking about some of the mistakes when it comes to the receiving your distributions, I'd like to share with our audience how they can have a complimentary consultation and receive a copy of the top 10 IRA mistakes that we have here by David Royer, and which I was endorsed. You can go to JustAskFreeman.com. We could schedule for you a complimentary consultation and get a free copy of this book, because it's vital to understand these mistakes when it comes to distributions from your IRA or your qualified plans, and how to navigate around some of the costly tax errors and mistakes, I should say, tax mistakes when it comes to these taxes in your distribution of your qualified plans. Well, let's look at mistake number 3.
Mistake number 3 is not properly designating beneficiaries, and these are common mistakes. You know, one is taking too much too fast. Think about a young person who inherits this large amount of money. They've never dealt with money.
Right.
And all of a sudden they got all this money and they don't know what to do with it. Then sometimes they do take too much too fast and don't know how to make it stretch.
And usually what happens, if a person is not used to saving money, all right, here's what happens. They get this large sum of monies. Usually they squander those funds within 9 months to 17 months. That is, those funds were put aside and set aside for the beneficiaries to have a lifetime income to basically improve their financial lot. Another common mistake, no contingency plan. Well, what that means is that when you designate your beneficiaries, alrighty, it may be that you just have a primary beneficiary. You need a contingent beneficiary as well. Suppose the IRA owner has a spouse and both die. All right. Usually, one of the spouses designate each other per se as a primary. But if there's no contingent, those funds can end up in probate. So it's best to designate the primary and then have a contingent beneficiary as well. And if they're minors or if they're adult children or whomever, if they're non-spouses, of course, make sure that they understand the stretch. And I recommend that you talk to your loved ones, okay, in which you wish to bequeath these monies.
And you know, another mistake is using a will to name your beneficiary.
You know, a lot of people want to use a will. They say, well, I have my beneficiaries, they are designated by what's in that will. Well, wrong. Here's the deal. When you fill out or complete the paperwork, that is the IRA document, and you designate your beneficiaries, Carolyn, that trumps the beneficiaries in that will. So you got to understand, name your beneficiaries and make sure that you have a copy of the beneficiary form. Again, it trumps any beneficiaries that you've designated in a will. Now, not keeping your beneficiary documents up to date. This is a common mistake, and that is why each and every year for our clients, we have an annual review, okay? What can happen is, suppose there was a divorce, or there's one of our clients, of course, maybe remarried, all right? Now, there's an upsurge, I should say, or a surge in blended families. Now, what can happen is, suppose the IRA owner is divorced, marries again, had designated the beneficiaries with the first spouse, okay? Then, of course, the IRA owner, suppose he dies or she dies. What can happen is that if there's the beneficiary form, that document has not been updated, there's a possibility of losing the funds. The children from the first marriage that you might have designated as a beneficiary may lose their inheritance, okay? So it's important to have an update on those documents annually. Another problem, mistake can happen, a designated beneficiary, like I said, could die, or a new potential beneficiary is born. So that can cause a lot of different problems, and I go back to keeping that beneficiary document up to date. Something else too, a common mistake. One of your beneficiaries maybe is financially well off, or the other beneficiary or a beneficiary becomes financially indigent. The benevolence falls into place when it comes to your legacy from this, or the funds from the IRA, is that it might be that you designate a higher percentage of the legacy or the IRA, all right, to the one who has financial difficulty, and then a smaller percentage to the beneficiary who's better off or financially well off. The last common mistake that we want to talk about, Carolyn, is a beneficiary that has a spendthrift problem. Okay, all right. Well, you can complete the beneficiary form such that there is a restriction on the distribution from that IRA. 5 years, 10 years, 15, 20, 25 years. And you can have that distribution come out, or you've designated the time when the spendthrift take the distribution, and you can spread it out. And when you're the IRA owner, you can do a lot with beneficiaries. I've had clients come and they talk to me and they say things like, well, you know, one of my sons doesn't act right. I always say, you know your children better than I do. He would receive these funds and it'd be gone in a month. Well, of course, if you know that son or you know that daughter or whomever you wish to leave your funds would squander those funds. Again, the document, that is, having your beneficiary document up to date such that you dictate how these funds will be distributed to the individual who is a spendthrift. Okay, you have control over that.
And you know, mistake number 4, Freeman, is not establishing separate accounts. And there's a separate account rule. You want to go over that?
Okay, all right. That dictates how that each beneficiary share must be divided into what they call, quote, separate accounts. One of the things you want to do is, let me give you a good example of not separating the IRA proceeds into several accounts. Let's say we have the IRA owner wishes to leave a child, an adult child, a certain percentage, let's say equal shares,
Okay.
all right, of 200,000, make it simple for brevity's sake. And the grandchild receives 100,000, equal shares, 50,000, and that grandchild is only 10 years old. Now, in the event of the death of the IRA owner, the proceeds would be distributed such that the distribution is based on the life expectancy of the 40-year-old, okay, of the parent. All right, now the life expectancy for that 40-year-old maybe is 35 years, but that 10-year-old stretches over 78 years, all right, or 77 years. And when the distribution is from the IRA is given to both beneficiaries, the 10-year-old would receive funds based on the parent's life expectancy, missing out on several decades of payout. And it would be a greater payout for the grandchild, okay, such that the funds would last a longer time, the taxes are lower than it is for let's say the father or the mother, whoever is the primary beneficiary who has that 40-year-old. Now, we separate these accounts
Yes, we
when
do.
we talk to our clients, such that each one who receives, receive the proceeds from the IRA, all right, Carolyn, they receive the right amount based on their life expectancy. So it is important to understand the separate account rule. As you mentioned earlier, it dictates that each beneficiary share must be divided into separate accounts in order to receive the appropriate amount over their life expectancy. And again, I will say, folks, get a free consultation, and you will get a copy of this text right here, okay? 10 top 10 IRA mistakes in how to avoid the IRA tax traps. It goes through all the mistakes that is made when it comes to distribution. And I know that a lot of you that are watching are concerned, especially those who are preparing for retirement, Carolyn, or already retired. They're concerned about outliving their resources. And they have qualified plans, okay? And knowing how to, what we do so successfully, have been doing it for a long time, is making sure that these qualified plans, or I should say the IRA, alrighty, is there such that it is guaranteed distribution and it lasts the entire lifetime of the IRA owner. And as we mentioned earlier, having the stretch option presented to that retiree, which most of the time, a lot of them get very, very excited. The fact, you mean to tell me that my monies will last through 3 generations? Yes, it will. So we help establish separate accounts and make sure that those funds, with the products we use and the companies that we represent, such that that distribution from those IRAs, individuals never run out of money. Let's go on to this mistake number 5. Too much of your IRA at risk. Now, Carolyn, when determining how much of your retirement savings to hold in the stock market, you tell me the 2 most important issues to consider.
The time horizon and your risk tolerance.
Exactly. Time horizon. And how many times have we given the presentation of when you indicate you have a lot of time in back of us, but a short time in front of us?
That's true.
Carolyn, you know, the clock on the wall, it says that our time is just about out. We hope that our viewers have enjoyed at least part 1 of our 2-part series on this book, Top 10 IRA Mistakes and How to Avoid IRA Tax Traps. We hope you complete this review in our next segment. If you have any questions about today's segment, please call us at 1-866-813-7233 or SAFE, 1-866-471-7233. You can use that, or email us at freeman@justaskfreeman.com, and we'll answer your questions, send you a free retirement kit. And thank you for watching Skills to Pay the Bills in today's segment of justaskfreeman.com. Carolyn and I will see you next week for another great show. Have a wonderful and prosperous week.